Hey, what's going on, ladies and gentlemen? It has been a long time since I have done a live stream. There's actually nobody on yet. So long, in fact, that I forgot even the software that I used to use, the name of the software that I used to do live streaming. Anyway, wanted to see if this is not my normal time to do live streams either. Wanted to see if there's anyone up for me to do a live stream with, and let's start talking about what's going on here in the stock market, right? So, yeah, why not? Anytime I get viewers out there, let's see what we got in terms of questions. Anyhow, let me see here. All right, so I'm open to any questions you guys might have. I'm just going to start doing some research here for my day, the stuff that I normally do, and I'm going to start looking at what's going on in markets here, what's going on with some of my favorite stocks. Feel free to chime in. Just remember that I don't. Well, right now I think I've only got one person watching. Um, but feel free to check in anytime you like, and let's talk about what's going on in the world, in the economy, in particular stocks you want to talk about. I do have a particular interest in technology stocks, particularly in electric vehicles, and the technology surrounding electric vehicles. If you guys want to have a talk about that, let's do that. I do have plenty of experience in the oil industry as well. I worked for the oil industry for quite some time, and in banking. So mostly on the financial end, but ask away any questions you guys might have. And let's see here. Michael Will says, "Hi, Jason. Yeah, I haven't been on in a while, Michael. So let's and I it's been a long time since I've done a live stream. I've had a lot of employees out sick lately, or one thing after another come up. So I've been covering their shifts. Like I've done everything from cleaning bathrooms lately to flipping hamburgers to teaching children's classes in jiu-jitsu to all kinds of stuff. So yeah, so let's talk a little bit about the global situation right now. Michael Will says world economics and affairs first, please. Yeah, so let's talk a little bit about that. So right now, when you look at the global economy, there's a lot of things that look enormously positive about it, right? But the big negative, of course, is inflation. Inflation right now is a global phenomenon. It is not limited to the United States. It is being politicized in a way that it's never been politicized before. But it is a global phenomenon right now that is related to supply shock. And that is something that economists have long known has been a cause of inflation, but it's complex. Anyone telling you that it's related to one thing like government spending or being off the gold standard or anything like anyone who tries to make a reductionist argument is wrong, just flat wrong. It is more complex than that. Economists don't even always understand what's going on with inflation, but that is the big economic threat to everyone going on right now. And also with the Russia-Ukraine conflict, that is a huge risk right there to supply chains, right? Supply chains are already being disrupted by the sanctions put on Russia. That's looking to only get worse. When I say supply chain disruption, I'm really saying that the flow of raw materials out of Russia is going to be pretty much going in one direction now or two directions. And that is going to be just to China and India at this point, and to Brazil and South Africa and a couple of other places. That what used to be what called the BRICS, the Brazil, Russia, India, China, and South Africa. those are probably because of what's going on right now. They may make some degree of an economic comeback where you really only had India and China kind of on the rise there for a while. And you had Brazil and South Africa. Well, South Africa was on the rise too, but Brazil and Russia really kind of stumbled in that BRIC group. This may sort of reinforce their economies a bit. So, and Bram says, hold on a second here. Bram always makes good morning, Jason. I'm in North Carolina cycling, trying to get rid of those 30 pounds you lost. So I'm actually, it's right at 30 pounds now. I'm down from about, 35 pounds. I'm down from about 210 right around Christmas time to 175 this morning when I woke up. So I know people that can't even tell that I've lost 35 pounds because I carry that weight well, but it's nice and evenly distributed. Anyway, back on to world affairs here. So the big threat right now is, of course, global inflation. So, folks, that I wouldn't necessarily compare what's going on right now to the 1970s. You should always keep in mind the phrase that history rarely repeats itself, but it often rhymes. I think that was a Mark Twain quote. I'm not sure. I don't want to take credit for that. But this is not exactly like the 1970s. It's more like the post-World War II inflation boom, where it was really about the explosion in demand and supply chains that weren't ready to handle it. Not only that, every crisis that we go through fundamentally changes the economy in some ways, and it takes a time for supply chains to figure that out. This was, of course, exacerbated by increased money supply and of course government spending. It's exacerbated by conflict at this point, and a realignment into this multipolar world. Although I don't necessarily believe that's going to happen. I think that the China-Russia axis will probably collapse in on itself as China moves to take advantage of Russian weakness. But that's just my opinion. I am definitely not a political scientist or a world affairs expert. I'm just an interested amateur. So what's going to happen is more aggressive action from the Fed, likely. Probably more aggressive action than they were likely to take just 3 months ago in light of accelerating snarls in our global supply chains. So and especially when it comes to food, our food supply chains, that's one of the reasons they're looking to do that. Now, I hear people talking about food shortages. That is extremely unlikely here in the United States for a number of different reasons. Now, we may see a price spike in wheat products probably beginning around June. And that is because a large portion of the harvest that would have happened in Ukraine is probably not going to happen, as many of those men are fighting. And a lot of people forget that Russia produces a lot of wheat as well. And a lot of those men are probably all fighting as well. And for a variety of different reasons, fuel deliveries, all that stuff, and of course the export of nitric acid, which is one of the precursor chemicals used to produce a lot of fertilizers. So the idea that that Russia has all of the nitrogen on the planet and they're the only ones that can make, and I actually heard someone making this argument that they are the only ones that can make fertilizer is just patently wrong. Fertilizer is mostly made from atmospheric nitrogen and natural gas. The United States is the Saudi Arabia of natural gas, and there's plenty of nitrogen in the atmosphere. It's literally 78% of the atmosphere. So right now, look, I know that the market has been really good for the last couple of weeks, right? So one of my accounts had literally lost like 40% since November, 50% since November, because it's heavily technology based, and it made this giant comeback in the last couple of weeks. But it's not one that I trust to any degree whatsoever. This is just normal bear market volatility at this point, and I don't expect things to calm down anytime soon. It's going to be months before we're out of this. However, you should be viewing this as an opportunity to warehouse some of your long-term picks. Now, particularly in the fintech space, I'm looking at warehousing a lot of, and I'm actually looking at buying some assets that I wasn't necessarily interested in 4 months ago, just because they've dropped to the sub $5 level. I'm looking at things like Money Lion, right? Money Lion, I kind of liked the stock before, but I wasn't going to buy it at those levels. Now that it's dropped down to I haven't looked at it in a couple of days, but it was like $3.40 a share or something last time I looked at it. very much interested at this point in Moneyline. But that would be a long-term investment, right? A seriously long-term investment. So one of those other ones that I made last year was a call that I made on SoFi, right? SoFi is one of my favorite stocks that's out there. It is gotten absolutely hammered. It's been totally brutal. And actually, let me just bring that up here. Let's do this ticker name here. SoFi has just gotten absolutely destroyed. And my average cost on that is down now to about $16 a share. But my average cost is high. I'm underwater on this stock. I'm looking to be underwater for quite some time. That hasn't stopped me from selling options on the stock, of course, and making money on it on the way up and on the way down. And in fact, my most recent purchase of SoFi was 30 contracts of puts, May 20 puts at $7.50 a share. I did that at $7.50 exercise price. So my total premium on that was like $2,630, which I used that to plow into other stocks, right? So and I did that because $7.50 looks to be not necessarily a floor, but definitely a price that that SoFi hasn't hit yet. But it looks like it could possibly be a floor. I don't know. It could go below that, but I'm actually happy to purchase another 3,000 shares at $7.50 if that happens, right? So between now and of course May 20th, if SoFi drops below $7.50, I'm on the hook for those shares. I have to buy them. Not a problem with that, because SoFi to me has always been a long-term investment. It has so far performed disappointingly for me, but my time horizon is quite a bit longer, and I have quite a bit of patience. So that's really the advantage that long-term investors have over everyone else, is that we have a really long period of time to say, aha, I won, right? So if you're just willing to ignore things while they're not going your way, but let's talk about whether or not SoFi is going my way here. And let me see if I can pull up their, let's see here. Let's get rid of that. Let's get rid of that. Let's get rid of that. Oops, that's one of my business emails. You guys don't need to read that. Let me see here. All right, so we're going to pull up some of SoFi's earnings here. We're going to take a look at what they've done, right? So we're looking at the big thing yesterday in terms of their news was the decrease in guidance because of the extending the moratorium on student loans, which is a pretty big deal. But it's also something that's going on for 2 years now, and SoFi has made plans and moved ahead of that. Now, originally, when SoFi went public in 2020, actually when they started talking about going public in 2019 publicly, or at least rumors were swirling, there was the possibility, the outside possibility, that just based on the way their loan operations were structured, that they had an outside chance of profitability by the end of 2021. Of course, that got blown away early in 2020, or at least midway through 2020, with the moratorium on student loan repayment. Right. So let's make one thing clear right now: the loans that SoFi has on the books right now, the student loans they have on the books right now that they refinanced, those are not affected by any sort of moratorium. Right. Those are private loans now. They're no longer federal loans. Those are refinanced. What they're talking about is the impact going forward on loan origination. There is almost zero reason right now to refinance a federal student loan. You have no payments that are due, right? You can make payments if you want and reduce your principal, but you have no payments that are due. You haven't had any payments for 2 years. So why would you want to refinance that into a private loan? So SoFi is actually still doing this, but the proportion of their business, which it used to be 84% of their revenue was from student loans, the proportion of that business has declined steadily over the years and has been replaced with personal loans and with home loans. Now, the volume of both of those is also going to decline as interest rates rise, but the profitability of each one of the loans they make is going to rise as well, as there is a greater and greater spread between what SoFi is getting the money for in terms of the interest they're paying on it versus how they're loaning it out. All right. Now, of course, if we go through series and if we go through a really extended and long inflationary period, those calculations are going to have to change. But generally, in periods of rising interest rates, financials tend to do well. I don't expect SoFi to be any different. So if we're looking through SoFi's quarterly reports here, let's talk about the growth in members. Despite everything that's happened with the last 2 years, SoFi is a growth story here. They starting off in Q4 of 2020 with 2 million or 2.5 million members. By the end of Q4 2021, that's at 5.173 million, close to doubling the amount of members I have. Products. Now, this is the important thing that I've talked about before. You're looking at a total breadth of relationship, which is not reflected in this graph, of course. But when it comes to any sort of financial institution, you're looking to make the relationship extremely sticky, right? Meaning you want to make it a real pain in the butt to leave that institution. And you do that by getting clients to have a variety of products. Now, that's the beauty of SoFi's flywheel strategy, like Amazon. They're basically trying to be the Amazon of financial services. Is that once you're into their system, like I have a crypto account through them, I've got a loan through them, I have an investment account through them. Although their investment platform is not my favorite, and they are adding features onto that, but I have a bunch of different things with them now, and I'm even getting offers right now for them to handle payroll for one of my businesses through them, and I may actually be going with them when it comes to that. But they're making it stickier and stickier and stickier for me to get in there. And if you look at the total amount of products, that is not as increasing as quickly as their membership has. And that was something that was predicted in one of the earlier meetings. They're like, okay, we're always going to get a number of those members that only have one product in, right? All right. So when we look at products by segment here, we're looking at lending products versus financial service products. The lending products they have grown, but they have basically been flat since Q4 of 2020. A lot of that has to do with there being almost no growth in home loans. Most of the growth in their home loan business happened in 2020. It's been good for 2021, but there's not a lot of inventory on the market. Yes, home prices are going up, but it's all about inventory and demand right now. We don't have a substantial, greater number of mortgages being issued by most major companies over there over 2020, right? So we didn't see a ton of growth in lending products. The products that we saw growth in were financial services products, right? And the tech platform, right? So we've seen a growth in financial services products from about 1.6 million to almost 4.1 million in just a year. This is massive growth in financial service products. Massive, massive growth. That's going to be hard to replicate going forward. I don't know if they can actually do that. And we're looking at the technology platform accounts. This is very interesting. Right now, the technology platform only produces a negligible amount of the overall income to the company, but we're looking at pretty substantial growth, 60% growth in this business just over a year, going from roughly 60 million accounts to 100 million accounts through their Galileo platform, right? Which is the acquisition of Galileo and the costs associated with that were one of the big reasons that that profitability was pushed out. Also, the cost of the bank charter, the cost of the bank acquisition, and the cost of acquiring the bank technology company that they're using, which, by the way, that is very interesting for South America. It's Technisys. They actually have their hooks in pretty deep into the South American financial market. They were one of the first true online banks. So there's more to that story than most U.S. investors realize with that. So somebody wanted me to address also executives leaving. That is, first of all, I was kind of concerned about that until I looked into that and I realized that these are all executives that are leaving from the companies that they acquired. This is a natural sort of pairing of redundancy over time, meaning a lot of those management positions, like middle management, a lot of those senior executive positions, once you acquire a company, some of those guys aren't necessarily needed. They're generally given sort of a really nice push off, meaning a giant bonus saying, be nice, don't say bad things about us. But this is a perfectly normal thing that happens during acquisitions, right? So SoFi is definitely a growth story. If profitability is pushed out to 2024, that doesn't necessarily worry me that much because I understand the costs associated with acquisitions. What I want to see is continued growth in their platforms. And some of this growth is not obvious to people that aren't on, or it's not even obvious to people that use SoFi's platforms. But we're looking at the growth in financial services and technological platform. I think that is super, super important. The plan is to have about a third of the revenue driven by loan operations, have about a third of the revenue driven by financial services and products, and a third of the revenue driven by their technology platform. That is SoFi's plan going forward. So, if we look at total revenue here, we're looking at year-over-year growth of about 43% full year between 2020 and 2021. We're also looking at here. So let me see here. See if there's anything else. Oh yeah, this is the last thing I wanted to show you on this. So between 20 and 2021, we saw a 2% decline in the issuance of home loans. That's kind of within the margin of error there. There are a few companies that grew their loan operations in that time period, but very few companies that did. And a lot of that has to do with they're just processing loan applications as quickly as they possibly can. Even though, and there's not a ton of inventory out there, and loans look pretty good up until, at least loan terms look pretty good up until a few weeks ago too. So expect an even further slowdown in loan origination when it comes to home loans. Personal loan growth was up 168%. Now, I don't know if you've looked at the terms for SoFi's home loans. I'm sorry, the personal loans. They're actually really good, and that's super impressive. So revenue on that has gone, sky high here. So student loans still, there was growth of 51% in student loan growth, which is surprising, right? Because there is I say this is for loan originations, not growth. So it grew 51%. And so total loan origination here, we're looking at $3.7 billion in 2021 versus $2.2 billion because this is in thousands, right? You're looking at 67% growth in overall loan operations. So I think that is pretty impressive there. What I would kind of concerns me here, though, is, like I said, is that home loan or personal loans make up such a large percentage of that. And I'm wondering if they're going to have a higher, like home loans don't generally have a huge spike in defaults when we have a bad economy, because mostly they're, especially when you look at SoFi's target market, they're looking at high net worth, poorly served clients, meaning millennials essentially that earn more $100,000 a year or more and have they're in relatively good financial condition, but they're not necessarily considered wealthy. And they're not, and generally a lot of those folks who have high earnings but haven't necessarily acquired, $1 million to spend, they aren't really treated all that well by a bank. Like you can walk in and make $200,000 a year, but you only have $40,000 in your bank account. You aren't necessarily really treated all that well by your bank. And this is one of the things that's fueling a lot of high earning folks to leave traditional banking, is they don't feel like they're getting the services that they deserve in a lot of cases. So when we look at the total proportion of lending products here in terms of the percent of change, home loans between 2020 and 2021, which it's just, this is in terms of dollar amount, guys, up 65% in terms of dollar amount, not in terms of like volume. Personal loans up 22%. In terms of dollar amount, and student loans up only 11%. So I don't understand why people are refinancing federal student loans at this point when you don't have a payment that's due. So kind of crazy, unless they're just refinancing to get some of those rock bottom interest rates. Okay, so yeah, and that's one of the questions that is an announcement on a board member change today on SoFi. Actually, I don't know if there's an announcement on a board member change today. I haven't paid too much of attention to that. So this morning, it is still 7:55 in the morning. Let me see here. Let's go back and answer some of the questions here. So Nicholas, those are, I hope I answered some of the questions you had on a call today. But look, I'm looking at this as an opportunity to warehouse SoFi stock at an extremely low price down the road. My initial price target in my head for SoFi has been pushed out about 2 years now, meaning I thought that they would probably be a $40 stock by the end of 2023. That's probably now pushed out to about 2025, which is a really good return on any sort of stock in that time period. So let me see here. Bram says, something I learned 45 years ago that seemingly insignificant events far away can have a very personal impact. So I pay attention to everything. That is true in more ways than we can imagine. So JJA says, any thoughts on recent Pong results? Yeah, the results look great, and they were about in line with the prediction video that I made in January, saying that there was going to be a huge impact to sales and deliveries in the early part of the year, the end of January and beginning of February, due to Chinese New Year, and then we're going to see a ramp up. Now, currently, the production capacity for XPeng is right at about 20,000. Right, they can't really produce much more than about 20,000 vehicles per month because they don't have the factory capacity to do so. They're running at full tilt right now, and their next factory is not due to be completed at the earliest until the end of Q4 2022. So they're pretty much stuck at around 20,000 in capacity until the end of 2024. They can continue to blame that on supply chain issues, but the reality is it's just poor timing, right? We're going through this market decline at the same time that XPeng is hitting the top of their manufacturing capacity. They've got 2 factories under construction right now. They're just not due to be completed until one at the end of this year and one, I think, in Q2 of next year. The opposite is true of NIO. They have a really large factory complex that should be coming online pretty much any day, right? They should be starting pilot production at one of those facilities anytime soon. And by the end of the year, they may have a total production capacity of about 600,000 units by the end of the year, depending on how quickly they're able to ramp up that factory. So their actual production capacity could increase. The issue that I have with NIO right now is where they're placed in the market, meaning the type of vehicles they produce and how far down they are in terms of the breadth of their offering, meaning their cars are pretty expensive. And XPeng's they have a focus a little bit further down in the market, where that slice of the market, there are tens, if not tens of millions more people that can afford to buy the base model of XPeng car versus whatever. So the big story in the EV market, though, in China is not XPeng or NIO or Tesla even. It's BYD. BYD is simply kicking butt, and there's no way around that. And if you looked at their Dolphin program, their base vehicle, their entry price is something right around like $13,000, right, for a car that has about a 220-mile range. Now, it's a compact car. It's made for the Chinese market. It's not one of those like Wuling minis or anything like that. It looks like a U.S. compact car, but it's specifically made for the taxi fleet. And like I said, their base model vehicle with not a lot of frills. It has a range of 220 miles, a lithium iron phosphate battery, that Blade battery. It is $13,000, right? So I've had the opportunity to get into a lot of electric vehicles recently. Just get in them and drive them around and that sort of thing. And I got to say that the technology offerings that I'm seeing from other companies, they aren't quite as impressive as what comes with a Tesla, but I'm not sure that I need all of those technology offerings. Any bare bones vehicle that has a stereo system and air conditioner and is battery powered might have a lot of appeal for people. And of course, Bluetooth connect your phone to, because I'm not convinced that your apps are going to be all migrated over to the operating system on the vehicle for everyone. I think there's going to be a desire to have a car that's less technologically advanced and fits in that $15,000 range. So a $15,000 electric vehicle with the range of a compact car, that era is already here. It is already upon us. I made a video a few weeks ago, just kind of tongue in cheek, saying, "Oh, it's over for oil." uh, based on what's going on in the California market, where we can see that 12% of vehicle sales in California last year, before prices went up, were of electric vehicles. And look, we don't have the grid to handle all of this here in California. Our grid is 20 years behind the time. We need to do a lot of work on it. But I'm telling you, this is probably the incentive that we need in order to do serious work on our grid and increase electrical production, whether that's from renewable means, whether that's from natural gas plants or newer technologies that I'm just not going to talk about right now. But this is something that's going to happen whether you want it to or not. And I'm surprised still by the amount of resistance that I hear from people when it comes to electric vehicles. Like someone just commented on one of my videos that Tennessee has 0.9% of vehicle sales in Tennessee are electric, and it's going to take a while for it to come there. It's not. It's going to happen far faster than anyone understands or believes that it's going to happen. This electrification of transportation in the next decade, everyone's going to be driving an electric car, except for a few specific purposes. Like if you need, to haul a 20,000 pound trailer, and I know a lot of people that do because they have a lot of toys and things like that, then maybe you'll still have a gasoline, but you'll probably have a diesel vehicle at that point, and you probably won't be using traditional diesel. You'll be using biodiesel or something like that. So, what the arguments that allow us to think the U.S. tech market to go up? So I think that the tech market in the US is going to be bound by a range for the next couple of months. So I don't recognize your username on there, new manager. So you may be like a new watcher. So I tend not to make a lot of like price targets for stocks. I tend not to do that just largely because I'm a longer term investor than most price targets go out to. And I think they're not very useful. Humans are really bad at predicting the future. But I can say that with the added pressure of the Fed looking to more aggressively raise interest rates, or more aggressively, and this is the main thing, more aggressively get rid of what's on their balance sheet, which is going to bring the price of securities down all across a range of securities. Like right now, what the Fed has done in the immediate term is affect short-term interest rates and cause short-term interest rates to rise, and it has actually inverted the yield curve a bit. They haven't started working on the entire range of bond maturities by pushing bonds off of their balance sheet. The idea was to sort of let them roll off naturally and not buy new bonds to replace those. There are a couple of people in the Fed right now, and it's good to pay attention to what the Fed says. In their official meetings, pay very close attention to what they say. Like in regular interviews, I pay a little bit less attention to that because that's individual members, voting members of the Fed. They don't represent the entire Federal Reserve, board that actually votes on decisions. But a couple of members have come out and said they would like a much more aggressive wind down of the Fed's balance sheet, meaning all of the bonds, the U.S. debt that the Federal Reserve owns. So the U.S. Federal Reserve has about, not U.S. Federal, but total U.S. debt, I think it's about $29 trillion. A little more than $9 trillion of that is owned by the Federal Reserve, which is owned by banks, right? It's owned by the members of the Federal Reserve here in the U.S., so it's owned by U.S. citizens. Another something like 14 trillion of that is owned by individual investors in the United States, and only about 8 or 9 trillion of that is actually owned by investors overseas or something like that. So the idea, of course, is that once they start divesting themselves of these bonds and allowing bonds that are maturing to naturally run off the balance sheet, is that it's going to depress bond prices all across maturities from 0 to 30 years out. So that's a guarantee that that's going to happen, unless we have, and this is the big thing. What a lot of folks don't realize about what was happening in the 1970s is we had supply shocks. Namely the 1973 oil crisis. Actually, was it 1973 or 1974? So basically, in retaliation for the 6-day war in between Israel and a number of Arab states, there was a kind of a follow-up to that called the Yom Kippur War or the October War. And because the United States supported Israel, a lot of countries decided to not sell oil to the United States. That caused a giant supply shock. It caused worldwide inflation, worldwide pain at the pump. And it wasn't just the United States. And that set off a series of things that caused inflation to run through about 1982. Right, it was we had really high inflation about 1982, but there were a couple of reasons behind that. Number one, there wasn't as much U.S. debt as there is today, and the creation of U.S. debt by the Reagan administration and by the Federal Reserve was actually quite calculated, not just spending to collapse the Soviet Union, but it was quite calculated to reduce inflation as well. And let me talk about this. So the whole world was also coming off, the dollar was coming off the gold standard. Many other countries are coming off the gold standard. And this is one of the things you learn in economics class, by the way. So there were countries all around the world that were hoarding US dollars in safes in their sovereign wealth funds, and they were pegging their currency to the US dollar, or they were just hoarding it like so much that there wasn't enough physical paper dollars out there to circulate in the United States for day-to-day transactions, and the government had to keep printing actual physical money just to keep enough liquidity in circulation, which is one of the weird things that hadn't happened since the hoarding started in the Great Depression. It was one of those weird things that was unexpected, where there were countries out there that viewed the U.S. dollar as a safer investment than anything else, like the physical U.S. dollar, and they would put it in their their national reserves and say, we're going to peg our currency to this. Argentina was one of the big countries that did that. There are a number of other countries. I think there's a couple of countries that actually still do that. They peg their currency to the US dollar. So when Paul Volcker, which, man, that guy had balls of steel. He was the most hated man on the planet. He deliberately crashed the economy by raising short-term interest rates. I remember, and don't ask me why, I'm the biggest nerd on the planet, but I remember when I was a kid, like in first grade, seeing signs in the bank for 6-month CDs at 18%. And that would have been like 1981, right? 80 or 81, I don't remember. But I distinctly remember seeing a 6-month CD at 18%. That's how high short-term interest rates got. It made it almost impossible to want to go out and get a loan, although my parents, their first home loan was at 16%, right? So where we were in Texas, that crashed the economy. Of course, that was right when Ronald Reagan took over. The economy declined. We had a recession, and that lasted. It was a pretty long time. And there's this famous story about Ronald Reagan not understanding what's going on. He and Paul Volcker went into a room by themselves, and when they walked out of the room, all of a sudden Ronald Reagan supported everything that Paul Volcker was doing. And I can only believe that he must have really concisely and clearly communicated what the danger of hyperinflation was, because to a degree, it was not being taken very seriously by politicians. They're like, hey, more money, it's good for everyone, because wages were rising at the same time. And basically a lot of politicians didn't understand how grave it was. So so that is not happening this time. We don't have people hoarding dollars. And once we raise interest rates really, really high, and we started issuing bonds, of course, and long-term 30-year bonds in the 8, 9, 10, 12% range. That made bond investments, U.S. bonds, a very attractive investment to put into sovereign wealth funds, and just hold them in safes. And foreign countries started doing this, and when they did that, it pushed physical dollars back to the United States. They literally pay U.S. dollars to buy those government bonds. They'd stick them in their sovereign wealth funds and they'd sit on it. I mean, why wouldn't you do it? It's making 8, 9, 10, 12%. This is 1982. The government actually took those physical dollars and burned them in giant bonfires. I am not kidding. That is why they shredded them and then burned them in order to reduce inflation, because the problem was actual physical dollars. The problem today isn't physical dollars. It's electronic entries. And using bonds as basically a giant cash sink has worked for a while. I don't know what they're cooking up in the future. I think that it's not simply going to be raising interest rates and increasing the rate at which you're selling U.S. government debt at higher interest rates. They're going to have to do something quite different this time around. Okay. So what that is, I'm not sure yet. They haven't signaled what their overarching strategy is going to be. So I'm eagerly awaiting what they're going to do, just like you are. Hey, just wanted to remind you guys that we do have the super chat features on. If you guys wanted to talk about that, anything else, let me know. Let me see here. Shoeless Joe says, good to see you back, man. How long do you think this dip is going to last on SoFi? I'm going to acquire over the next few months. So I have a lot of SoFi, and I told myself that I wasn't going to buy anymore, but I just sold 30 put options on SoFi a few weeks ago, made a good chunk of change, and I did not use the $2,600 in premium that I received for those 30 contracts to buy more SoFi stock. I use it to buy different stock. But if I end up owning another 3,000 shares at 750, I'm perfectly happy to do that. And in other accounts, I'm acquiring smaller amounts. But no, I'm happy to acquire at these low levels. I think that we're probably, until people start understanding the results that we're seeing and the fact that this is really a growth story. I don't know if you saw the earlier part of the broadcast that I did, but SoFi is a growth story, and that is totally reflected in their numbers. And so I'm going to be acquiring for as long as I can, as long as it makes sense. And And Alex, I talked a little bit about Neo earlier in the cast. Let's just go over that again. So Neo has had a little bit more trouble with supply chain issues than other companies have, and that's because I think they just haven't focused on managing the supply chain. That's really the genius of both BYD and Tesla, is that they are, I mean, really forward thinking and have really done they've really rethought how the supply chain works overall. And this is where companies like Ford and Chevy, or Ford, GMC, and everyone else is behind, is that their idea of a supply chain is, let's just buy it from someone, right? Tesla recognized a long time ago that there was no lithium battery supply chain. They were going to have to create, I mean, not one that was able to handle any auto industry, and they were the ones that were going to have to create it. So they've gone out and pre-negotiated lithium supply contracts with different companies. They are buying up lithium mining rights themselves. They are investing in lithium mining companies, not just that, nickel mining, manganese, all that stuff. But I'm going to tell you, we're going to see cobalt disappear out of most cathode chemistry. You're only going to see it in the highest end models of Teslas. We're going to see nickel disappear out of a lot of cathode chemistry here. And I'm telling you, the cathode chemistry that is going to be king is going to be iron ferrophosphate. I'm sorry, lithium ferrophosphate, which is iron, lithium, and phosphate. None of those cathode materials are supply constrained. None of them are rare at all. None of them are concentrated in countries with problematic politics right now. So, guys, lithium is not rare. Lithium is widespread. Lithium is just highly reactive and doesn't occur in its natural elemental form. And there are forms that it occurs in that are easier to process than others, just like oil. There's plenty of, like, Canadian tar sands oil. It's oil, but it's really hard to process, and oil needs to be a very high price in order to make it profitable. Lithium, certain types of deposits are the same way. Of course, the lithium salts that we hear about, the bromide, or the lithium salts that we hear about, those are the ones that are most easily processed. And also, we may see ocean mining of lithium coming up pretty soon. The vast majority of the world's deposits of lithium are actually in seawater. It's highly reactive, just like sodium is. And when I say just like sodium is, of course, there's some chemist is going to object to this, but the chemistry of sodium, meaning in this type of chemistry, how it loses electrons and gains electrons, meaning how useful it is for batteries and electricity. Sodium and lithium are very similar. I will not be surprised in a couple of years if we see sodium ion batteries or potassium ion batteries in scooters, in watches, and everything that takes lithium ion batteries today that isn't like high demand or requires under 200. Like your phone battery really only has like 300 cycles, 400 cycles in it. That could easily be replaced by a sodium ion battery. And it has, like I said, similar battery or similar chemistry when it comes to electronics. So I'm very, very, very hopeful when it comes to the electrification of transportation. I'm telling you guys, this is happening so quickly. If you go on a drive right now from my house to one of my businesses, I guarantee you that 1 out of 10 vehicles you see probably more at this point, is an electric vehicle. Because I tend to only notice the Teslas, but lately I started to notice Mach-E's everywhere. There's a couple of small compact electric vehicles that I've noticed that say electric on the back that I don't even recognize. One of them was yeah. So I'm just very excited about that. Yeah. Let me see here. I'm holding Bama, SoFi, and FTH. This is a good idea. So, man, there's so much that goes into that very simple question. Is it a good idea? So some of the concerns when it comes to Alibaba were, of course, delisting. I'm beginning to think that I have a personal distaste for Jack Ma, which is probably unjustified, and which is probably affecting my thinking on Alibaba. And I'm starting to reevaluate that. Right, I want to put aside any irrational notions that I may have about the company, and let's look at the overall prospects for the company. So I'm coming around on that. But the big concern with Alibaba is they've lost political favor in China. Jack Ma is not well liked by the government at this point. And there's also the threat of delisting. Now, the threat of delisting has taken a bit of a back seat. And I'm not sure that it was ever as big a threat as certain YouTubers and media personalities wanted you to think, largely because negotiations have been going on in earnest and in good faith since the very beginning on this subject. The Chinese regulators are just really good negotiators. They have very good reason for, because this is a great source of, and actually it was someone involved in the intelligence community who made this point to me, is that financials for a company like DJI, who is very closely connected to the Chinese military, would actually give us a lot of really good open source intelligence on where they're putting their money in their research in. So if we had really good unrestricted access to all of their financials, it would be really good for the U.S. intelligence community, and they know this. So it's not surprising to me that they have some objections to to having. But if you want access to U.S. capital, you have to play our game. So they're going to negotiate some happy medium, and it's probably going to happen last minute. I think there's going to be plenty of opportunity to invest in Alibaba and any other Chinese stock that's out there. Now, a couple of companies already made moves and have gone public on the Hong Kong Stock Exchange. So if they're delisted here, your shares are likely to become H shares, Hong Kong shares, or you're probably going to be able to exchange it. They're not going to just, especially the companies involved in this, they're not just going to screw over all of their U.S. investors. Yeah. I'm going to take a look at new comments here. Epic Cancer says, it's good to see you back. I hope all is well in your life. I think it's time to load up on SoFi because I can't imagine student debt being forgiven forever. Yeah, so they're not forgiving. So the federal government could come out tomorrow and forgive all of the loans out there for student debt. That would affect the balance sheet of the loans that SoFi has, not at all, because those are renegotiated private loans now. I'm actually in favor of, and this is a controversial statement, I'm actually hugely in favor of student loan forgiveness, period. I think they should just, largely because it's a great move for the economy. 92% of student debt is actually owned by the U.S. Treasury Department, meaning that we could literally just forgive you, and it would it would not affect any private businesses right now doing that. It would affect loan origination for SoFi, of course, and it would harm my investment in that company. But I think that the overall benefit to the economy would be much, much greater because we have an entire generation, and now we're working on a second generation of people that really aren't fully participating in the U.S. economy because their debt load is just too high and their interest rates are too high on that debt, and they're spending their disposable income that they would normally use for consumption on servicing debt. So I'm setting aside my issues of fairness. Look, I went to university, acquired some debt, paid it all off myself. Do I get screwed in this deal? Yes, I do. I absolutely get screwed in this deal. But what is better for the economy as a whole matters, not my personal feelings on this. And people that are really opposed to this idea are allowing their personal idea of what's fair or not, or thinking that just because I suffered, you have to suffer too. And trust me, we suffered paying back those loans. When we did it over a really short period, and when I say that everything, including our diet, suffered, like really, we ate rice and steamed vegetables and noodles, because like no protein because we couldn't afford it. And it took 2.5 years to pay that all off. But just because I suffer doesn't mean that everyone else should suffer, especially when it's not good for the economy as a whole. Millennials aren't waiting to buy a house until they're 40 because, of any other reasons we thought. They're waiting because they couldn't afford it. And it was a lot of that had to do with student loan debt. And a lot of it's because we sold folks. The big reason behind it is the proportion of a student's tuition that the state pays is much lower than it was, say, in the 1970s and 80s. Right? And that's why tuition has gone up, is because the states have stopped funding. And this is perfectly in line with the availability of student loans. The Federal Reserve actually did a research project on this where there's a perfect correlation between the availability of student loans and the greater share of tuition being pushed off on the student. We live in a globally competitive world, and we need an educated population. And I think that the last 2 years between the United States and Russia are telling us what an uneducated population can do to a country. And more college education is needed, not less. A lot more is needed, and we need to make it less expensive and more accessible. And we need the people that we kind of convinced that I had to go to college at all costs. And college is not for everyone. You can make a great living at a trade. You can a great living in a trade. Some of my best clients, my financial advisory practice, were tradesmen who did really well, who just saved money and were smart with the things they did. So, okay, on back to technology here. Michael Will says, you mentioned a few months ago that you were looking at Albemarle. Have you any updates on your thoughts? Yeah, I've been slowly acquiring Albemarle. When I say slowly acquiring Albemarle, it's been like one share per week. Because of what's going on with all my businesses right now, I actually have a little bit less in the way of disposable income. So when it comes to a long-term investment, I think that Albemarle it's pretty hard to say no to that at this point. They have their hands in every part of the lithium battery supply chain. A lot of the techniques and processes that they come up with can also be used with alternative chemistries as well. I just think that they're well positioned to be one of the, honestly, I think NVIDIA is going to be one of the best performing stocks over the next decade, right? Large cap stocks. It's going to be beat out, of course, by some small caps and mid caps that we don't know what those are right now. But in terms of large cap stocks, I think that NVIDIA is probably going to be one of the best performers in the next decade. I think Albemarle could run a close second to that. And I don't know if you consider them a mid cap maybe right now. I don't know. I haven't looked at their market cap in forever. But I think that they're going to be one of those companies that benefits hugely. So the companies that aren't going to benefit from the electrification of transportation are the ones that don't do anything special, meaning the component makers for like chargers. I hear people make these arguments all the time. And what they don't realize is that the charge points and the blinks and all that, you're going to have disappointing performance out of those, largely because and there are thousands of electrical component manufacturers in the United States. There are tens of thousands of them in China. They're all going to get into the charging game, and nothing about making an electric vehicle charger is special. Nothing. There's no special technology in it. There's no special techniques in it. It's just going to be who can manufacture those the quickest. And I honestly think that in terms of charging, like Tesla owns the vast majority of charging infrastructure right now, but you're probably going to see municipalities get into the game, and they're not going to all buy from one company. These two companies that are public right now, like EVgo, or is EVgo public? They're not going to buy from Blink and EVgo, and it's not going to. It's going to be a winner take the most kind of deal. So you're going to have to pick and choose, but there are all kinds of unknowns out there that are going to start making these components, and there's going to be no way to predict exactly who is going to be the winner, and it's going to be really spread out, right? Like I said, destructive competition is the name of the game. It's kind of like, basically, I think that investing in a charging company would be a lot like investing in an airline company right now. So I'm not saying that the entire airlines as a whole, like the entire industry, is not actually profitable, right? So you have Southwest is the only company that consistently makes a profit, and that's because they're really good at hedging fuel prices, or they have been in the past. But they were the only company that made profits. As a whole, the airline industry needs a bailout every 15 or 20 years It's always been like that. They've never been self-sufficient. They've always need government help to run to a degree. I don't think that like charging infrastructure is going to be like, but I think they're going to suffer the same problem, which is destructive competition. There's so many players in the field. There's so little that distinguishes them from one from the other that it's going to be very hard for a company to stand out. So yeah, Albemarle I think is going to be a great way to play the lithium battery supply chain. I will say that the other thing that I'm acquiring in that is just LIT or BATT. These are two ETFs that are in the lithium. And this is what I suggest people do is go a little bit broader in terms of that. And the one thing I would not be doing right now is picking individual lithium miners. We have no idea. I don't know enough about any mining operation to say that this particular patch of land or this particular holding is going to be the most profitable in the long run. I think it's a better idea to hold those assets in an ETF that's broadly diversified right now. And as we see performers emerge out of the field, to go heavy into those performers. Yeah, you're going to miss out on some of those early gains, but you're also going to not have the opportunity of investing in a giant dud, which, I don't know if you guys remember 3D printing back in like 2010. I invested real heavily in a couple of 3D printing stocks. It was too early. The technology still has not lived up to its promise. And I got crushed on those and lost money and have been down for a long time. So, there are a number of different types of investments that are going to be like that. So, Michael Will says, whoops. Michael Will, there you go. I bought the LITG ETF. It's lit in the US, good mix of miners and battery suppliers. Yeah. And it's not like there's just chemical suppliers in there as well that are not necessarily obvious to you unless you really study the lithium battery supply chain. And I think that is just a safer option right now. And that's going to give you, it's going to keep it on your radar. And it's going to give you a good window into which companies are starting to really outperform. Are you talking about here, Shitless Joe? Are you talking about Gore's Guggenheim GGPI? Okay, it says Gore's Guggenheim does not have significant operations. It intends to affect a merger. Who are they going to be merging with? This is what I have not. Is this the one that's going to merge with Polestar? No. This is another SPAC. Okay. Yeah, it looks like they're going to merge with Polestar. So Polestar got a decent shot in the arm recently with, I think it was Hertz announcing that they were going to buy 65,000 Polestar vehicles, which I thought was a very interesting comment. So I am reserving judgment on SPACs right now. I think that after the SPAC wipeout of last year, that did happen. And that was predicted by a lot of different people, not just me. The only SPAC that I purchased last year was SoFi. I could say that I regret that now because I'm so far down, but I really don't. I'm still holding more than 7,000 shares of SoFi at this point, and I've got an order out there, or I could possibly own another 3,000 here by May 20th. So yeah, I do think that see, a second. Garage New 360 makes this comment here. I don't know why it's taken so long for StreamYard to work out. But Garage New makes this comment here: uranium or lithium for invest in 10-year at stock market. Thank you. We covered that. Uranium is tough to invest in, right? It's tough to know whether you're going to make money in that. There's so much political pressure against the construction of new nuclear power plants. Although I think that I think we may actually get that accomplished here in the next 10 or 20 years, the production of new nuclear power plants. I don't think it's going to happen somewhere like California. I think it'll happen somewhere like a Utah or Arizona or Wyoming or something like that. So I do think that's going to happen here in the near future. One of the things that we're probably actually looking at in the near future here too is migration, meaning that people in the United States are going to be moving locations quite a bit more, largely because of remote work, and that's going to change the makeup of economies. Also, we're probably going to see a decline once production starts to increase again. When the OPEC Plus deal that Donald Trump signed in 2020, that reduced production by OPEC, expires, I think, in late April. And so we are going to see, and that's when we'll see the crawdad effect with OPEC. If you guys aren't familiar with what crawdads do or what crabs do in a bucket, if you throw a bunch of them in a bucket, when one of them starts to climb out, the others grab it and pull it down. When that deal expires, that's what's going to happen with oil prices. That's probably going to be the cap on oil prices right then, because certain producers are going to start trying to produce more in order to take advantage of high prices, and they're all going to do it, and that's going to put a cap on those prices. The only caveat to that is the wild card there is, of course, futures trading. How is that going? If you look right now, gas prices are higher than they were in 2007. In 2007, oil reached $147 a barrel just based on future speculation. We haven't gotten to that point yet, but it looks like we're getting. And oil is actually down from its peaks of like 126 here recently, but its gas prices are much higher, 20% higher than they were, at least here in California, than they were in 2007 when oil prices reached a peak of 147 on the fears of peak oil, which I don't know that we've reached peak oil yet. But yeah, and that's such a complex question. There's a guy on TikTok who's kind of, I forget his name, but he's globally recognized as a subject matter expert in the oil industry and production. And he has a 3-minute video where he tells you, there's no way to tell when an oil well is going to stop producing oil. There's just too many factors involved. No way to tell how long it's going to last. No way to tell when we actually are going to reach peak oil production. But yeah, so let me go in here. Any other questions? What does in play mean for SoFi? So in play is a sports reference. I know you're not a native English speaker, Nick. It's a sports reference, just meaning that now is an opportune time to do something. So I don't recommend, of course, that you go out and buy, sell, or hold any security to an individual on a YouTube live stream. It's just not a responsible thing to do for someone who's a licensed professional. But yeah, it just means that there's an opportunity to do something meaning that if it was fully valued, right? Meaning if it was, say, $25 a share and that was the full market value and they were a profitable company, it may mean that the company's not really in play because it's a full market value and it's only going to grow with the revenues. There's no additional growth on top of that that's expected, right? But right now, when you're looking at a price at close to $8 a share, I don't know what it is. This morning it was close to $8 a share. See if I'm going to be the proud owner of 3,000 new shares of SoFi by the end of the week. Oh, it's at 772. Looks like I'm pretty close to being the proud owner of 3,000 new shares by the end of the week. Although that put expires May of 2020, and people have been holding on to options instead of exercising them, or they've been dumping them, and then whoever buys them are holding on to them. They haven't been disposing of them. So I've taken the opportunity to roll some options here. These times in the market where the market declines, this is a great time to start an acquisition strategy using cash secured or margin secured puts, especially if you're willing to warehouse a stock for a long time. If I were to buy 3,000 shares of SoFi at 750, and I used a put to do that, and that's my floor for that particular lot, and I can actually sell by individual lot in my account, I can guarantee you that I will turn around, sell a 6-week, 90-day, 180-day call on that same set of shares, way out of the money, of course, but I will do that immediately in order to generate income on that. And that's one of the things that's really good to do in a down market to help you actually increase the breadth of your holdings while everything is down. And then when the market recovers, you actually recover a lot more quickly. So you see here. Port City Trading Desk. What would you do? Let's see. I don't know why your comment. Oh, there we go. It's slow down. Support City Trading Desk says, what will you do with 100K if you are 25? A lot goes into that question, Port City Trading Desk. Is this your only $125,000? Do you have an emergency fund? What kind of work do you do? What kind of skills do you have? What are your job prospects? Um, the the fewer job skills you have, the more I think the less risky it would be. Like if you are in a high earning position with a huge future ahead of you and lots of job opportunities and a growing skill set, then I don't think taking a lot of risk with that money is out of the question. But if you had 125 or $100,000 at age 25, then and you were had a high school education, waited tables somewhere, uh, didn't have plans for an education, I would consider being a lot more cautious with those dollars, meaning go ahead and look at having an asset allocation like a mutual fund or ETF asset allocation, and not investing in individual stocks. Now, if you are someone who has an appetite for risk and has the ability to earn money and resave that $100,000 over the next couple of years in case you lose it all, taking a risk on some individual stocks or even, you know, that ETF that I was talking about earlier, the LIT, which is the lithium ion battery chain ETF, which holds stocks from any lithium related stock that's related to the battery chain, like the battery chain, right? Supply chain. I think that would be a great investment over time for 10 years or so. Nathan W says interest rate goes to 3%. Do you think SoFi will go down more? So there shouldn't be a ton of okay. So when it comes to valuation of future cash flows and interest rates go up, companies redo the math on how much those future cash flows are worth based, compared to a risk-free investment like a bond, and they reduce their target price based on those and what they're willing to hold. So will it affect the share price? It will affect it some. It will affect it temporarily, but what's going to affect the share price is actually positive results from this point on. And the results for SoFi are pretty much all positive in terms of their product growth and numbers. Even the numbers that are most out there in the media in terms of their student loans, even those look positive. And I can't believe that there are people still refinancing their student loans in this atmosphere, but they are. So it's not going to have and that's the main thing. All growth stocks are reevaluated. You're reevaluating future cash flows in comparison to a risk-free investment. That risk-free investment basically had a 0% interest rate for the last 8 years, 12 years. Now that's 2% or so. So you're discounting future cash flows against a 2% risk-free cash flow when it goes up to 3%. So don't get hung up on magic numbers on what's going to cause a market crash. I had a number of people last year that tell me that the market was going to crash when we hit 2% on the 10-year T. That's just not true at all, and it's not likely to happen. I think that we are in for a bumpy ride for the rest of this year and into next year with stocks, meaning it's going to be hard to make money overall. You're going to have victories and you're going to have losses. And I think that patience is what is generate as much income as you can now and broaden your holdings. And when you see those recoveries, they're going to happen a lot faster than they have in the past. Use options to your advantage. Sell, and if you want to acquire a stock right now, sell a cash secured put. Generate money on that stock just for thinking about buying that stock, right? For example, like I told everyone on this earlier, I sold 30 contracts on SoFi at 750 for with a March 20 expiration with a strike price of 750. I sold a few weeks ago, generated $2,600 in premium. I took that $2,600 in premium and I invested in something else. If I happen to have, and it's looking like right now by the end of the week, I'm going to be the proud owner of 3,000 new shares of SoFi. Happy to own it at that price. And I'll turn around and sell a call option on that right away. And I'll ladder my way up. In this particular account, I do a little bit more. I don't actually do any buying and selling. I sell options. Meaning that if I buy and sell anything, it's because the option was exercised. And that's the only thing I do in that account. And I'd love to talk to you guys about that sometime too. It might be just better if I just get on my account one day and show you. But yeah, let me see here. Michael Will says, any chance you'll look at GAN for a future video? Let me see here. What is GAN? GAN Limited. Here, we'll take a sip of my coffee. Let me see. It says why GAN fell 22% open today. Well, I'm not seeing a ton of information on them. Hold on a second here. Keep getting an advertisement blocking me here. Probably, I don't know, man. That's like I haven't really covered any internet gambling or casino like stuff on my channel before. I think about DraftKings a lot, and that's a little bit different. I understand, and like real money gaming and simulated gaming stuff, like money gaming. I haven't covered any of that. I get it's not very interesting to me. That's probably why. Yeah, but and I am looking at doing sort of a recap of what I talked about today in SoFi when showing you guys the graphs. I'm gonna do a video on that as well. I do think that people are missing the point when it comes to SoFi here, is that SoFi is actually doing everything right. They made a few moves that I didn't necessarily understand at first, but in terms of executing their strategy and increasing the share of revenue for their other two segments, which is financial services and technology and their technology platform, they're killing it. They're absolutely killing it. And I think a couple of years from now, early investors like myself, like I think my holdings will be worth $1 million or more in the next 5 to 6 years. I really do. I think that in the next 5 or 6 years, we'll see SoFi looking a lot like Square in terms of a share price. And yeah, I'm not going to put an exact number on there, but I think we'll be close to that. So this has been one of the few times in my career where I've been that certain of a stock. I'm never really certain, of course, and lots of companies that I thought were sure winners ended up being losers. I don't know if you guys ever remember Lucent. There was a company that was around. They may still be around as Lucent Alcatel, but when they were just Lucent, they were one of the hottest traded stocks in like the late 1990s. Man, did I get burned on that stock. And a lot of it happened because I had so much confidence in the company, but I really did not understand what they did. And the stock started dropping. And that's when I realized that I had been suckered by their awesome commercials and all of the hype from all the other people, because I was working in this giant trading house where I was a technology guy. I was not a trader at the time. And I was basically I ran the network and wrote software, and I did everything technology wise. And these guys that were trading the stock all the time got me kind of hyped up on it, and I let my emotions get in the way. And I realized when it went from $80 a share to $50 a share, I had no idea what I was looking at. By the time I understood what was going on, it was like $10 a share or something ridiculous. Like I ended up losing a lot of money on that. So, yeah. So Nathan W says, "Are you concerned about high SoFi stock-based compensation?" So no, and let me tell you why. Number one, let's compare this to Palantir's 2020 stock-based compensation, and compare it to and it's the same thing. That is the year that they went public. There is a lot of stock-based compensation in the year that a company goes public, but normal for a lot of companies right now in the early years after they go public, it's somewhere around 20 to 25% of their cost is going to be stock-based compensation. But if you look at more mature companies like Tesla, their stock-based compensation is still 12% of their overall expenses. And that's largely because of the competitive environment when it comes to technology employees, and the fact that this is one of the most, Silicon Valley is one of those places that, in terms of money, at least, it's pretty highly democratized. Most companies that you work for have a stock-based compensation program of some sort. It lowers the overall cost. It lowers the actual salary that you're paying. Like if you look at engineers that work for Palantir, they make like, I think they're capped at like 137,000 a year in terms of what they're paid, and the rest of what they're paid is in stock-based compensation. Now, this is great when your company, the stock price is growing, or it's great when the stock price is low and you think you're going to acquire more because of dollar amounts. But if the price languishes for too long, you'll start to lose talent. That hasn't started with either SoFi or with Palantir yet. But if we look 2 years down the road and Palantir is still stuck at $12 a share or whatever it is today, and SoFi is still stuck at $7.50 or $8 a share, they're going to start losing talent to companies whose stock prices are growing. So no, am I concerned by that? No. The reason it was so high, if you look at Palantir's, their stock-based compensation was like 100% of their overall, of their actual sales. Right. So they paid just as much in terms of stock-based compensation. I think it was more than 100% of their sales in 2020, because that is the year that they went public. 2021 was the year that SoFi went public as well. So that's thing. Claire says, thanks for making me feel better about my 50% loss in SoFi. I'm down in SoFi too at this point. My overall, I think my initial purchase was my cost right now is right around 16. So I'm down about 50% as well. I'm looking to buy more. I own more than 7,000 shares. I'm looking to buy more at this point. So this was a totally unplanned live stream, guys. I literally got up this morning. I spent way too much time actually just staring at my accounts and said, you know what? I'm not going to do that today. One of my calls that I was going to have canceled. So I'm like, hey, I'm going to do a live stream. Wasn't planning on doing it today. The only reason I haven't been doing the regular Wednesday evening live stream is because I've been having to cover shifts at my business for people that have been businesses for people that have been sick. So so that's it. But anyway, guys, I wanted to leave you today, and I am actually going to be going on vacation for a bit here to see family in another state. I'm going to be putting out videos in that time period, but I'm going to take a much needed break. The last few weeks for me have been absolutely nuts, between an absolute nightmare doing my taxes. I don't even remember what I put in the video this morning about the 7 common tax mistakes, but that wasn't my issue this year. My issue, only one of them was my issue this year, where I could not get people to give me the documents I needed to do my taxes. In fact, it's one of my LLCs. I still don't have a K1, and now it is April 7th. I just got 1099s issued for one of my businesses when I'm supposed to have those on January 31st. And it's been a nightmare working with all the different accountants. I have to consolidate accountants, meaning I like the financial professionals that I work with. I'm going to have to reduce the amount of financial professionals that I work with, just because it's gotten too complex, which is a good problem to have, folks. It's a good problem to have. I don't like being as busy as I have been for the last couple of months. And I should probably start talking a little bit more about how I've reached financial independence. Like my day is, I do what I want to. Like, I look at my accounts, maybe do a trade here or there. I do a little bit for client accounts. I go for a walk. I go to the beach and surf. I go work out. I go train jujitsu. I work on my boat. I actually almost completed, like yesterday, I finished wiring my boat that I built from the ground up. It was a pile of lumber a few years ago, and now it's an 18-foot center console, and I'm about to start fishing in it this summer. And I'm really happy about that, because I built it in an extremely fuel efficient manner. For a boat this size, you can't get something that is more fuel efficient. And it was just pure luck that now gas is $6 a gallon out here in California or more. But anyway, so I should maybe talk to you guys about that sometime, kind of show you how I've built my businesses and how I've structured them, and how I'm not there to work at all of my businesses unless they need me for actual labor. And they will now, and I totally understand that. But I'm looking to acquire more businesses this year, and I'll talk to you guys about that. And I'll even take you around a tour of my bar and the kitchen that we opened there at some point, or maybe I'll even do a live stream while I'm flipping burgers there, and I'll answer questions on the live stream. Anyway, nice to talk to you guys again. Nice to see you guys, and I will see you next time. You guys have a nice day.